Good evening, everyone. Good evening. Welcome, welcome. We are going to be starting here in just about 1 to 2 minutes. We'll be recording our session this evening, so I'm especially looking forward to catching all of you that maybe didn't get us on the way in, but we'll be catching it on the replay later. We will be on our YouTube channel. All right, now I can see you guys. Hello and good evening. All right, we have a special guest on, my friend Sam from Cross Country Mortgage. He is our guest this evening. He's going to talk to you a little bit more about the unique parts of these programs. But for those of us that have already been through the training with Freddie Mac, and that training with Freddie Mac as agents was wonderful about 2 weeks ago. They originally sent us the details on tonight's idea, but then they are not actually a lender. So that's the first misconception you may have, is that Freddie Mac is a lender. They are not a lender. They are actually, of course, a government entity, but they are going to be there to help facilitate the process and buy the securities, as they call them, the mortgages later on. So what they are going to do is they have come up with the idea of these tremendous low money down programs that are going to get more of us into homes. For those of us that are realtors, more of our clients into homes. But the big things to know this evening is you may have already thought that Freddie Mac was a lender. They're not a lender, but these great lenders that are out there, and not everybody does or understands as a lender the Freddie Mac loan products that we're about to talk about tonight. So I don't want to take up too much of your time, but I do want to encourage you to do a few things. The first one is, if you haven't already, connect with one of the lenders here on this webinar this evening. So I'm sorry, with one of the realtors here on the webinar this evening. I was looking at our friend Sam up there in the corner. But get with one of the Exit Realty realtors. We are all trained and coached to help you in the process. It is a little bit tough right now to find the inventory you want, particularly in some of the lower price ranges. But we're seeing that stop. We're seeing some more inventory come. And it's been coming the last few weeks. It's actually been out the last few weeks. So inventory is up 5% over the past 10 days. That is tremendous. And contracts are down. So if you're a seller, maybe a little bit of concern there. If you're a buyer, this is great news, because we've been trying to get you into more. Talk to your Exit Realty agent. Let's get together. Make sure that you're on our app, that you've got everything, your search set up right, that you're going out to properties regularly with your Exit Realty agent. If you haven't checked out our digital buyer presentation, it helps you walk through the process. But now is the time to buy. And why we say that is that this is the time, mostly because of the interest rates. And Sam's going to be able to talk to you a little bit more about interest rates in a moment. But we know that the interest rates on average have never been below 3% more than 2 other times. And both of those times have been within the last 18 months because of COVID. So this is an opportunity to lock in a great rate and get a property at a interest rate you'll probably never see again, at least in my lifetime. When I first got my first property, was an FHA loan, so a Fannie Mae product, which is the sister entity to Freddie Mac in a lot of ways. And that Fannie Mae FHA loan was 8.75% interest, if you can believe that, in 1998. And I did not have bad credit, I swear. Have had good and bad credit over the years, have worked with a lot of great credit coaches to make sure that myself and my clients have 700, 800 credit scores. Guys, if you are getting on, that's great. Please mute yourself. I think somebody's in their car. So I don't want to go ahead and do that. So, Martin, I'm going to go ahead and my friend. All right. So, guys, I am so excited about the opportunity in the market right now as far as these record low interest rates. It also is a good time to buy, even though the inventory is low, because the inventory is going up. Your Exit Realty agent has been trained in some great areas as far as getting some private listings to you, some stuff that's not yet on the market. Maybe they're doing some door knocking or direct mail in the areas you want. They've got that app to send over to you that is free, so that you've got everything right in your fingertips every day. But this is the time. And we don't think these interest rates are going to last more than maybe the end of the year, the beginning of next year, and they're going to go back up to where the banks make more money, because unfortunately that is a pressure from the banks on the Fed and on everybody else. I'll let Sam get into more of the technical details, but what really encouraged me about the Freddie Mac programs we're going to talk about is that more of you can get into homes for less money down than with many other programs out there. This isn't a grant program where you've got to jump. Not everything in these programs has restrictions on them. So I'd strongly encourage you to talk to Sam. Maybe you've got a different lender you're talking to. Make sure if you want to do something with Freddie Mac that they understand the loan products that Sam's about. So without further ado, I am going to go ahead again and mute a few people that I think they've got some background noise. I want to make sure that everyone can be heard. And then Sam, let's go ahead and have you begin, my friend. So I'm going to make you the host here, and feel free to mute everyone, including myself, if you need to. So I'm going to go ahead and make Sam the host. And thank you again, Sam, for making time for us tonight. The Freddie Mac folks, they were wonderful with agents. They do not typically do direct presentations to the public. They like to do it through the lenders. So we're really appreciative of Sam being able to get on this tonight, and we're going to make him the host now. So Sam, you are now the host of the meeting.
Perfect. Thank you, Nick. First of all, guys, my name is Sam Apozeri with Cross Country Mortgage, and it's such an honor and pleasure to be here. When Nick asked me, I was really excited. And Nick, just a big shout out to you. The fact that you know how much inventory there is in the market and the way it goes up and down, that's just part of the value that brings to your clients. So big shout out to you. I want the meeting today to be very interactive. I know a lot of you guys have your videos off. If you want to keep it that way, that's fine. But if you want to jump in, say something, or give me some reactions through video, that would be fantastic too. The first thing I actually want to know, and you can type this in, is how much experience you guys have with mortgages out there in general. I'll give you guys a few seconds to type in any responses or turn on your videos. Not at all, not all at once, guys. So we'll take the overview, a very big general overview today. We'll go a lot into Freddie Mac, and we'll go into some comparative Fannie Mae, how they compare side by side as well. But at the end of the day, keep in mind that the programs are perfect. The programs out there are just designed, they're tools to get our buyers into their homes. And each one is designed to satisfy a certain need or help a certain type of client get into their home. So we have the low income ones, like with Freddie Mac, Fannie Mae, and FHA, ones with low down payments, various different types of loans. So I'm going to start sharing my screen here with you guys. Can you guys see this?
Yes, we can.
Perfect. So if you have a pen and paper in front of you, the first thing I want you to do is actually write down on the top of the page 4 things. 1 is cash. 2 is income. 3 is credit. And 4 is property. So these 4 categories. At the end of the day, all lenders, we're going to judge a borrower based on those 4 categories. And we'll go into Fannie Mae and Freddie Mac into specifics, and we'll touch on all of those. This slides are quite long, but I'll keep it quite speedy. Again, if you have any questions, stop me at any time. So those 4 factors are what we judge the client on. But what we want to know as well is what's the most important thing to the client throughout this entire process. Because one loan will mean lower monthly payments, while one might mean lower down payment. So each one is designed really specifically to the client. So first thing first, what's the loan limit? The confirming loan limit for Chicago for 1 unit this year is $548,250. That number will go up again in 2022. It's always dependent based on the previous year's average sale prices. And as we know, every year, specifically this year, people bid so much over asking that number is only increasing. Now, what kind of different terms there are? We have the 30-year, 25, 20, 15, and 10. And there will be a 40-year coming out soon too for specific buyers. So that's going to help a lot more people actually qualify because their monthly payments will be lower. There's also adjustable rate mortgage, or ARM for short. Those are also coming back. They're not very popular because a lot of people associate them with the crash in 2007, 2008, but now they are very strong. And I actually recommend them to some of my buyers that I know for a fact will not be staying in a place for 15 to 30 years. So we'll continue going over this. So one thing, if you're talking about someone that doesn't have a lot of money to put down to buy a home and get a mortgage, they probably don't have enough for closing costs as well. In Chicago, closing costs, in Chicago and greater Chicago area, closing costs run about 2 to 5% depending on the purchase price. If your purchase price is $400,000 and above, you're about that 2% mark. If your purchase price is $100,000, you're closer to that $5,000. And that closing cost needs to come usually from the borrower, but it can also come through a seller concession. Now, this is very important because with FHA, you can go up to 6% seller concession, but with Freddie Mac and Fannie Mae, if your client is putting less than 10% down, we're capped at that 3% mark. So that's something to really keep in mind for your clients who really don't have that much cash to put down. We'll keep going through this. Now, the reason I asked you to write down those 4 factors and also to write down what's the most important thing to your client is because of this thing called private mortgage insurance. Private mortgage insurance is basically every time your loan to value is, every time your client puts less than 20% down to buy a home, they have to pay this mortgage insurance. And it will automatically drop off at 78% loan to value, or when they get to 22% equity in the home based on the initial purchase price. That will automatically drop. But depending on the credit score, private mortgage insurance can be quite expensive. And this is where a lot of the low income products that Freddie Mac offers really start to shine, because they also bring down that private mortgage insurance for our buyers who are considered low income. Now, but still keep in mind that if a client has the ability to put more down and they want to have a low monthly payment, maybe this private mortgage insurance is something they really, really do not want in their mortgage product. So I'm going to scroll down specifically to the product options here. So FNMA stands for Fannie Mae and FHLMC stands for Freddie Mac. So looking at that credit score that we talked about that you wrote on top of your paper, Fannie Mae has a hard cutoff of 620 credit score, whereas Freddie Mac says, we're going to look at you holistically as a borrower, which is a huge plus because a lot of people fall in the category of 610 or 599, and otherwise they're great borrowers, but with Fannie Mae, they could never get a loan. So Freddie Mac starts to shine. Now on the property types, I think most of your buyers, or if you're a buyer yourself, you're looking at 1 to 4 units properties anyway, but that's kind of the limit of the mortgages out there. Potentially you can do co-ops. Actually, cross-country can help with your co-op. Not a lot of lenders do. Now, as far as down payment goes, the amount of down payment you're going to have depends highly on what the purpose of this purchase is. So I think everyone here is talking about primary home purchase. It basically means that you're buying this home to live in it yourself. If you're going to live in it, you can put 3% down. So down payment is always the flip side of the LTV. So if the LTV here says 97%, your down payment is going to be 3%, which is a fantastic product. And remember that the seller can also give 3% in seller credit to help with the closing costs as well. Now, another thing to add on here is that that 3% doesn't always have to come from the borrower. It can also come as a gift from a friend or family. A friend, it has to be somewhat related to the borrower, by the way. The 95%, that's for Fannie Mae. Fannie Mae caps at 95%. Just another reason why Freddie Mac is so good for people that need that extra push to qualify for a home. So the reason we're all here for the Home Ready and Home Possible products. Fannie Mae's low-income product is called the Home Ready, and the Freddie Mac's is called Home Possible. Here, like I mentioned, no minimum borrower contribution. What that means again is that that down payment can be borrowed from a family member, or not borrowed, it can be a gift from a family member. Pricing caps we won't talk about. The reduced MI again stands for mortgage insurance. And this is where I think these products really start to shine. With Freddie Mac, when you can go up to 97%, this 25% compared to 35%, that's a coverage on the property. What that really means is that the monthly mortgage insurance that you pay can be all dropped by about a third, which is quite significant. So you can, as you can imagine, a buyer that's very close on a debt to income ratio qualification, one of the 4 factors we talked about, that third drop can bring them from $60 to even below $40 in terms of monthly mortgage insurance. And that can be the extra push that they need to qualify. Now, one key word here is the low income. Well, what does low income really mean in Cook County and Chicago? Anyone or any household that makes $73,000 or less every year. And when we look at households, we're looking at only people that are on the mortgage and not their immediate family as a whole. So if you're someone who makes $71,000 and your spouse makes another whatever amount that puts you over, well, if your spouse is not on the loan, then you still qualify for these 2 products. And that's where a good mortgage lender will come in to help you really qualify for the best options for you. Now, do you have to be a first-time home buyer to qualify for these mortgages? Not necessarily. If you are a first-time home buyer, you could get extra help, but you don't have to be a first-time home buyer. And just to clarify what a first-time home buyer means, it just means that you haven't owned a home in the previous 3 years. Any questions so far?
Sam, I have one question. And this is really great information. Are you going to get into, so if they're getting a gift of the down payment, could they also still have the seller contribute closing costs? And if so, how much, what's the limit?
That's a fantastic question, Nick. Yes, the seller can still contribute and seller credit. If you're putting less than 10% down, 3% is the max
3%.
that the seller can contribute.
And for those of you in the audience, whether you're an agent or a buyer, consumer of ours, that what is exciting about that, and I had to be reminded by Sam, is that most of the time the closing costs are probably going to be hopefully under 3%, depending on the price of the property and all that good stuff. If that's under 3% and you're getting a gift for the down payment, you could be in a property with 0 out of pocket, which is amazing. That is really, really special. Thank you, Sam.
Absolutely. That's really the beauty of these products. These products are designed to put people in homes. In America, the American government just loves the idea of home ownership. It's what drives the economy. It really is. It's a huge multi-trillion-dollar industry. So anything that the government can do, and Freddie Mac and Fannie Mae are sponsored by government, anything they can do to help people buy homes, they want to do it. So if you have any borrower that's in doubt, any buyer that's in doubt, or you yourself as a buyer wonder if you can qualify or not, chances are you will. So just start looking and start asking questions, and people will show you in the right direction. Now, this area median income, again, that says, so in Cook County, the $73,000 for the income limit that I said, that's for Cook County. But the way that's calculated is basically we look at the median income in the county that you're in, and at 80%, you want to be at it or below it to qualify for these products. Now, homeownership education, it's super easy and simple to do. Whenever you start the product, we'll show you how to do it. You don't have to worry about any of it right now. It's something that comes through the process. I won't go into the refis unless anyone wants to. Now, one thing, again, is that even though these products, as Nick, you mentioned, that you could potentially buy these homes with a gift from family and the seller credit contribution from the seller, you can buy with $0. But with these products, you could still qualify for specific grants, like the IDA loans, where they give you the down payment in terms of a loan. So you could still qualify for those, which make them even better. And again, you can have reduced mortgage insurance at the same time. So really, you will qualify. Basically, what these loans do is the 4 factors that I talked about: cash, credit, income, and property. They get rid of that cash part and they help you with the income, debt to income ratio, which is the income part, to make you qualify for the home. Okay. Again, this is all the different ways you can help with the 3% down payment that most people will go. A lot of community loans do help out with those. Those community loans, just as a heads up, do have to be approved by lenders. If they are of any significant size, they almost always are, by the way. Now, Home One, Nick, you specifically asked about this Home One product, and like, what's the difference between a Home One and a Freddie Mac Home Ready? Well, the main difference is that with a Home One, you're not bound by that income limit. So you can still get to that 97% LTV or 3% down payment and have as much income as you want to, like $100,000. You're definitely there's no limit on your income. The home buyer education is still required, and again, no worries on that one. Anyone else has any questions so far? Perfect. Now, can you combine these products with other products like a home style or a choice renovation? Well, with Freddie Mac, you can. You can get a choice renovation. Now, a lot of these products were discontinued shortly because of COVID. They are starting to come back. Some of them are quite strong. I think Freddie Mac actually has a really good one where you can get a loan for yourself to be the person that does the fix up, which is fantastic, because if you're familiar with a 203K loan, you need to go through a licensed and approved contractor. It's a very long and strenuous product, but with Freddie Mac, you can get that loan yourself to do the renovations yourself. Now, this is most of what I wanted to cover here. Nick or anyone else, I want to dive deeper into what questions you guys have or where else I can kind of answer questions.
Sam, I did have one more question for probably a couple of us on here. I noticed that this product also does work for a second home, and that's 10% down, whereas, in some programs it's 20% down, 10% down on those second homes. What if you're going to also use it, it's a vacation home? Is there any restrictions on Airbnb or things like that? I know it's kind of a more technical question.
Yeah, that's a great question. So it gets to a gray area. Are you going to live there yourself as a second home as well? If the answer is yes, it's your property. You can do what you want with it, really. But if you're buying it only to use it as an Airbnb and you're never going to go to it, then no. That's the gray area that we fall under.
Okay, I would think that would also probably be it would kind of fit in the same laws that the tax laws are as far as vacation homes, where you've got to, there's only a certain amount of time you can rent it out and still qualify it as a vacation home. So you can't be always renting it out. So maybe talk to your CPA, but I wasn't sure if there was any specific language from them, from Freddie Mac, or from you guys as a lender?
Well, one thing I want to add on that is a lot of people buy 2 flats or 3 flats and use the rental income to qualify. You can never use Airbnb income in any way to qualify for a mortgage, even if it has an existing Airbnb income, just as a heads up.
Yes, thank you.
Anyone else? So we've been going for about 20 minutes right now. I can go into a lot more technical aspects of it, kind of how underwriting views it. But one more other thing that I want to cover is derogatory credit. So every now and then we'll have people who have had bankruptcies or foreclosures, just anyone has gone through a tough time. And a lot of times they wonder if they can qualify for a loan or not. The answer is yes. And actually, we can go through all of it here. Perfect. So looking at Freddie Mac, if you have a Chapter 7 or Chapter 11 bankruptcy, you generally have to wait 4 years, but under special circumstances, it can be 2 years. And just as a heads up, I really haven't seen anyone get this special treatment for 2 years. What about Chapter 13, where it's 4 years from dismissal date or 2 years from discharge date? And if you've had bankruptcy, 5 years. If you've had 1 bankruptcy, 7 years if you've had more. And for any short sale, 4 years. And again, this extenuating circumstances, I just haven't seen anyone qualify for them, so I won't even touch on it. As you can see, it's pretty similar to Fannie Mae in that regard, but if you have someone that doesn't necessarily meet that 4 years or 5 years, 7 years, that's where FHA and government loans can come in and shine. Generally, what we say is, if you have great credit, let's put you in Freddie Mac or Fannie Mae. If you don't have great credit, let's put you on FHA. Or if you have to buy a condo, let's try to find a way to get you to that conventional Freddie Mac or Fannie Mae loan. Because most condos are not FHA approved. Now, one more thing, actually a couple more things. Self-employed people. This is where Freddie Mac again really outshines Fannie Mae in terms of just making it more accessible for people. If you've had a business for more than 5 years, you can use 1 year of tax returns to qualify for Freddie Mac. Whereas with Fannie Mae, you have to use the previous 2 years. And the way that's calculated is with Freddie Mac, we just look at your previous year's filings, say, okay, that's your income. Now, are you in line with that this year? Meaning, are your year-to-date profit and loss, does it match up? Are you going to make the same amount you made last year that you filed or more? That's a fantastic thing that helps a lot of people, especially with COVID and like next couple of years coming. A lot of business owners, unfortunately, had a really, really tough 2020. Now, when they file their taxes, how it's going to come out, they want to buy homes. They probably might not qualify right away, but if they just wait 1 more year where this business gets back to normal, you can qualify them again. Whereas with Fannie Mae, it might not work out. Now, I also want to go over people who just don't have any credit. This really applies to a lot of people that come out of college. They haven't really built any credit. If there's no credit score, that's not a problem. We can work with the clients to basically build a manual credit around them. We can do things around light bills, electricity, gas, anything that shows that they can pay, they are credit worthy and that they will pay back. With Freddie Mac, they're actually quite lenient again. There's no minimum requirements or anything. As long as holistically as a borrower, they are good and we can show it, their findings, the LPA, that's the Freddie Mac system that will say the borrower is good, we can still lend them money to. So they again help pretty much everyone get a loan. as long as somehow they can fit at least 3 out of those four criteria that we went through. Now, one more thing that it's about students. With COVID, a lot of students don't have to make payments. And this is going to come to an end as the student forbearance comes to an end. But with Fannie Mae, if anyone was in student forbearance, meaning they showed they don't have to pay any student loans, we had to consider the entire principal of their student balance and use 1% of that as a monthly payment, which for someone that has $50,000 to $60,000 of student loans is really, really high. It's a common thing that people have that much student loans, and 1% is quite high. With Freddie Mac, it's only 0.5%. So it's half of what Fannie Mae does. Again, helping a lot of students with large student loans particularly get qualified for these loans. So that was the last bit that I wanted to cover, just showing how Freddie Mac really helps everyone buy homes. I'll open it up again to you, Nick. Do you want to ask any questions or highlight anything that I didn't cover?
I think you did a wonderful job. The 3% down, the ability to have gift money, the ability to have a grant stacked on top of that, the ability for the seller to pay your closing costs, ask your exit realty agent about that, really opens up a lot more opportunity to people. It is a government-backed program, so you feel, there's some lenders out there that have some interesting programs. I can't always guarantee you that those programs fully work to the end or anything like that. This is a government-backed program, and I really appreciate, Sam, your slides were wonderful. They were broken down so much better than anyone else's that I've seen, particularly for our friends in the consumer audience here. So looking forward to having this recording out to everybody by tomorrow. And obviously, if anybody else has questions, we would still love to hear them.
Appreciate the kind words, Nick. It always means a lot. And if you want to reach out to me directly just to go into much more depth, I'd be more than happy to.
Perfect. All right. Thank you all so much for being here tonight. Thank you, Sam. Everyone, you'll have Sam's contact information in the YouTube video when we send it out to you through Eventbrite. Thanks so much, everyone.
Thanks. Bye, everyone.
Bye.